While retail investors argue about which crypto will be the next 100x winner, institutional capital is quietly playing a completely different game. You've seen the red charts in your altcoin portfolio and read the headlines about big money fleeing the market. But what if you're not witnessing an exodus? What if you're misunderstanding a calculated reallocation? And the reason they're doing it has nothing to do with price and everything to do with risk. The truth isn't that institutions are abandoning crypto. They are strategically repositioning for the next phase of market maturity. There is a hidden force driving their decisions, something that separates the way they allocate capital from the way most people think about their portfolios. This isn't a flight from crypto, it's a flight to quality within crypto. They are consolidating power, fortifying their positions in the most secure and liquid assets, and preparing for a much larger wave of adoption. This is a tactical rotation, not a retreat. So let's follow the money, analyze the data, and reveal the grand strategy at play. By the end of this video, you'll understand why this drawdown isn't the end for altcoins, but a foundational shift that could inform your own strategy. To see what's really happening, you have to ignore the sensationalist headlines and look at the hard data. In plain English, we need to follow the money. The real story is in the capital flows. First, let's look at the ETF effect. The launch of spot Bitcoin ETFs wasn't just another product, it was a superhighway connecting traditional finance to the digital asset world. For the first time, major institutions could get Bitcoin exposure through a familiar, regulated vehicle. The inflows have been massive, with tens of billions of dollars pouring in. These aren't small bets from fringe players. We're talking about giants like BlackRock, the world's largest asset manager, making significant public moves into the space. This isn't panic, it's deliberate positioning. Here's what that actually means for the market. A March 2024 survey from EY and Coinbase showed that for institutional investors, the primary demand for crypto exposure has shifted. A significant percentage of institutions now prefer to get exposure through registered products like ETFs, rather than buying crypto on the spot market. The Bitcoin ETF is the path of least resistance, and institutions always follow that path first. In simple terms, institutions are entering through Bitcoin first because it's the easiest, safest, and most regulated door. You can see this playing out when you compare altcoin performance against Bitcoin. If you hold a diverse crypto portfolio, you've felt this divergence. Many altcoins have been bleeding value, not just against the dollar, but against Bitcoin itself. Professionals watch this through a key metric: Bitcoin dominance. This chart simply measures Bitcoin's market cap as a percentage of the total crypto market. For much of the recent past, Bitcoin's dominance has been stubbornly high, maintaining a stable upward trend and hovering in the mid 50% range. When this number rises, it's a clear signal that capital is flowing out of altcoins and into Bitcoin. It's a classic risk-off move within the crypto asset class. In a volatile market, the less liquid, higher risk altcoins always get hit the hardest. Institutions, driven by sophisticated risk management, are moving capital from the speculative branches of the tree to the solid foundational trunk, Bitcoin. That's the shift. Not money leaving crypto, money moving within crypto. So why is this massive rotation happening now? It's not random. It's a convergence of three powerful forces: a deliberate risk management strategy, an uncertain regulatory environment, and a massive wave of industry consolidation. This is the hidden strategy that most retail investors miss. The first driver is risk management, and this is where most retail investors get it wrong. Institutions don't just buy assets. They assign them specific roles in a portfolio. Think of it like a toolkit. Bitcoin's role is the store of value, or digital gold, the portfolio's anchor. Ethereum's role might be the utility layer for building applications. When market volatility spikes, what's the first thing a professional does? They reduce exposure to higher risk utility plays and increase their allocation to the stable anchor. They aren't trying to pick the one coin that will win. They are managing risk by reallocating capital based on the role each asset plays. This is what separates traders from capital allocators. The second major force is regulatory uncertainty. For an institution like a pension fund, an unclassified token isn't just a risky asset, it's a potential legal liability. They assign a risk premium to that ambiguity. For institutions, uncertainty isn't just risk, It's something they are legally required to avoid. So while progress has been made, the lack of a comprehensive legal framework in the US creates a chilling effect on altcoin investment. The Financial Innovation and Technology for the 21st Century Act, or FIT21, passed the House in May 2024 with bipartisan support, but still faces an uncertain path in the Senate. Until that regulatory fog lifts, why would a fund risk allocating billions to a token that could be deemed an unregistered security next year? They won't. They are flocking to the one asset with the most regulatory clarity and a regulated ETF to access it, Bitcoin. The third and final driver is a huge wave of market consolidation. The crypto industry is entering its great consolidation phase. Think of liquidity like the depth of an ocean. Institutions are like massive container ships. They can't navigate shallow waters. They need deep liquidity to enter and exit large positions without crashing the price. Mergers and acquisitions, M&A, activity in crypto has climbed, with many venture capitalists expecting it to increase further as the market matures. This consolidation naturally funnels liquidity into the biggest and most established assets. As the industry coalesces around a few dominant players and regulated infrastructure, capital flows to assets with the deepest liquidity and clearest utility. And right now, nothing has a clearer position than Bitcoin. This isn't a retreat, it is a highly strategic consolidation. So what does this all mean for you, the individual investor feeling the pain of this rotation? It can feel like you're on the wrong side of a trade that only the big players understand. Like the game changed and no one told you the rules. But this institutional shift is not the death of altcoins. It is a necessary and ultimately healthy flight to quality. This is the market growing up. For years, the crypto space was a wild west where hype alone could create astronomical valuations. That era is ending. Institutions operate on risk management, compliance, and utility. Their arrival is a great filter, separating the digital wheat from the digital chaff. And this is not a blanket rejection of all altcoins. A recent survey from Coinbase and EY highlighted that 73% of institutional investors currently hold at least one altcoin. And look at the actions of the institutions themselves. BlackRock didn't just stop at Bitcoin. They launched their BITL fund, a tokenized US Treasury fund, on the Ethereum network, and have since expanded it to numerous other blockchains. These are not the actions of investors who think altcoins are worthless. They are the actions of selective investors picking their spots, focusing on high utility blockchains that can serve as foundational layers for the future of finance. The pain is being felt most in the long tail of speculative, low utility projects. This leads to the key takeaway. Reevaluate, don't liquidate. This market has given you a powerful signal to look at your portfolio through an institutional lens. It's time to ask the hard questions. Does this token have a sustainable use case beyond speculation? Does the platform generate real revenue? Is there a strong developer community building on it? The projects that can answer yes are the ones likely to attract institutional capital when it rotates back. This is your opportunity to reassess your own strategy and decide if you're aligned with where the smart money is headed. If you're getting value from this kind of analysis, take a moment to subscribe and hit the like button. It helps the channel tremendously and ensures you won't miss our future updates as we track this monumental shift in the market. Let's bring it all together. The headlines about an institutional exodus from altcoins are focusing on the effect, falling prices, without understanding the cause. Big money isn't fleeing crypto. It's executing a disciplined rotation based on three core drivers: risk management, regulatory uncertainty, and market consolidation. They are trading short-term speculative bets for long-term strategic positions in the market's most secure and liquid assets. The institutions built their superhighway into crypto with Bitcoin ETFs, and they are using it to establish a strong foundation. The progress of legislation like the FIT21 Act is the key variable to watch. Its passage could be the green light that unlocks the next wave of capital for a new class of institutionally vetted altcoins. So, what should you watch for next? Two key signals. The first is Bitcoin dominance. A sustained move below its recent highs could be the first sign that capital is ready to diversify back into high-quality alts. The second is the news flow around further regulatory clarification. Once institutions have their core positions secured, they will inevitably look for new use cases and higher yield. The approval of spot ETFs for other major assets would be the clearest signal that the next phase of the institutional rotation has begun. This is not a time for panic. It's a time for strategic patience. The game has changed, and the smart money is playing by a new set of rules. And when that capital rotates again, it won't be spread evenly. The question isn't which crypto wins, it's which role it plays.